A Financial Analysis of Agilent Technologies versus Waters Corporation by Nakayla Noonkester and Cory Bly.
Waters Corporation and Agilent Technologies are both companies in the medical laboratory and research industry. Waters Corporation has institutional ownership of 51.61% stock in Waters Corporation. 466 institutional hold shares. Individual stockholders hold 5.04% and mutual fund holders have 39.89%. Institutional investors purchased a net 935.1 thousand shares of Waters Corporation during the quarter in December 2014 and now own 91.5% of the total float, a percentage that is typical for companies in the medical specialties industry. Agilent has institutional ownership of 36.77%. 646 institutional hold shares. Individual stakeholders hold less than 1% of shares, and mutual fund holders have 48.93%. Institutional investors hold a majority ownership through 85.7% of the outstanding shares that they control. The interest is also higher than at most other companies in the biotechnology industry. Last, during the quarter end October 2014, these large investors purchased a net 1 million shares. Waters Corporation's top 10 investors own 43.07% of the company, whereas Agilent Technologies own 40.17%. Of the top 10 investors, both companies have three in common: Vanguard, State Street Corporation, and BlackRock. All three of these companies invest more in Waters than in Agilent.
Cost of capital for investors refers to the opportunity cost of making an investment. So why do shareholders care about our cost of capital? Our rate of return on an investment may be larger if funds were allocated to an alternative investment with the same risk. The cost of capital, in turn, becomes the rate of return to sway a decision to make an investment. Cost of capital is not dependent on the source of the funds, rather what is done with them. Any given investor typically expects their investment to grow at least by the cost of capital. If proper investing decisions are made, investors are able to maximize profits and returns. On the other hand, if poor investment decisions are made, investors can take on much greater risk.
What is our cost of debt financing? The pre-tax cost of debt financing can be estimated by adding the default spread to the risk-free rate for each company. According to the U.S. 10-year constant maturity rate, the risk-free rate as of February 9, 2015 is 1.77%. Waters Corporation has a AAA rating, whereas Agilent Technologies has an A rating. By comparing Waters Corporation and Agilent's credit rating, we found Waters' after-tax cost of debt is 2.1%, and Agilent's after-tax cost of debt is 2.3%.
What is our cost of equity financing? Waters' 10-year Treasury constant maturity rate as the risk-free rate. The current risk-free rate is 1.77%. Beta is the sensitivity of the expected excess asset returns to the expected excess market returns. Waters Corporation's beta is 0.39. Expected return of the market, risk-free rate of return, is also called market premium. Required market premium is 7.5%. Agilent, the 10-year Treasury constant maturity rate as the risk-free rate is 1.77%. Agilent's Technology Inc. beta is 0.79. The expected rate of return on the market is also called market premium. Required market premium of 7.5%.
What is our overall cost of capital? Capital is the funds companies use to finance their operations. The cost of capital is the cost of a business incurs to obtain those finances. Cost of capital is important because it is the means of buying a new plant or developing new innovative ideas. In order for a business to invest, the return on the investment must be greater or equal to the cost of capital. The weighted average cost of capital for Waters is 4.51% and Agilent is 7.11%.
Could we lower this by changing our capital structure? Yes, we could increase leverage by issuing debt and repurchasing outstanding shares, or we could decrease leverage by issuing new shares and retiring outstanding debt. We want to choose capital structure at which our stock price is maximized. Trades off higher ROE and EPS against higher risk. The tax-related benefits of leverage are offset by the debt's risk-related costs. The firm's optimal capital structure can be determined in two ways. Minimizes WACC, maximizes stock price. Both methods should yield the same results.
How would a financial restructuring affect the value of our company? Financial restructuring can affect the value of our company by addressing poor performance, exploit strategic opportunities, and correct evaluation errors. It is designed to increase the value of the firm by improving capitalization, improving debt composition, or change ownership and control. We can restructure the business by applying the following. Figure out what the business is worth now by using the valuation model. Fix the business mix, which diversifies by evaluating assets to be sold. Fix the business with a strategic partner or merger by evaluating the merger firm with synergies. Fix the finance, improve the DE structure by reevaluating firm under different leverage assumptions, lowest WACC. Fix the kind of equity by asking what can be done to make the equity more valuable to investors. Fix the kind of debt or hybrid financing by asking what mix of debt is best suited to the business. Fix management or control by evaluating the changes new control would produce.
Would more debt create unnecessary risk? While debt is usually the easiest form of financing because it merely entails borrowing money, excessive debt may increase the financial risk of the business and drive up the cost from all sources of financing. Debt, when invested, multiplies risk and reward. The risk of leverage is investing that debt and losing what you have borrowed. Depending on the leverage ratio, your equity can be wiped out if the investment drops. The more debt per equity, the riskier the investment. The advantages of using debt as capital structure: you have cost reduction, profit retention, financial leverage, and tax savings. The disadvantage of using debt as capital structure: you have flexibility loss, bond rating decrease, possible conflict between stock and bond holders, and higher default probability.
Who is the competition and what do they do? We compared Agilent and Waters to Thermo Fisher, who is their main competition. On the chart shown, green is the S&P index, pink is Dow Jones, blue is Agilent Technologies, orange is Thermo Fisher, and black is Waters Corporation. The median EBITDA for the peer group is 12.96. Waters Corporation showed an EBITDA ratio of 13.98 for the next 12 months. Agilent, on the other hand, had 12.23, which is lower than the median. According to this valuation, Waters is above the peer group, while Agilent is on the lower end.
Is our stock fairly priced? We use the discounted cash flow model for Waters because they don't pay dividends. We use the same model for Agilent because they have an irregular dividend pattern. Decreasing positive cash flow, Water is investing back into its business at an average of 21% of operating cash flow. Cash flows are trending up. Based on our research, we have determined the stock is overpriced for Waters Corporation. For Agilent Technologies, decreasing positive cash flow, Agilent is investing back into its business an average of 15% of operating cash flow. Cash flows are trending down slightly. Based on our research, we have determined the stock is overpriced for Agilent Technologies. Thank you.